Good afternoon, everyone, and thank you for joining us for another Beale & Co webinar. Today's presentation is going to focus on the topic of insurance brokers E&O in light of the coronavirus pandemic. One of the most immediate insurance impacts of COVID-19 has been the deluge of businesses across the UK looking to their insurance cover to indemnify them in respect of their losses. However, as many of those businesses are finding out, the insurance world is not coming to their aid particularly quickly, if at all. In this webinar, we're going to look at how unsuccessful insurance claims by policyholders may ultimately rebound and result in negligence claims being made against their insurance brokers and their PI insurers. And we'll look at whether or not such claims are likely to succeed under the UK legal system. My name is Joe Bryant, and I'm a partner in the professional liability team here at Beale & Co. Today, I'm being joined by my fellow partner, Stephen Reilly, who is also a partner in the professional liability team. I'm very pleased to see that we've got over 200 people from the insurance industry attending this webinar today, which clearly demonstrates that there is significant interest in this topic, and rightly so, given its potential ramifications for all of us as insurance professionals. Just as a point of housekeeping, today's presentation will last hopefully around 1 hour. And a recording of this webinar and a copy of the slides will be circulated to all attendees following the presentation. So please do feel free to circulate those once you receive them amongst any colleagues that you feel might be interested, or do contact either Stephen or myself if you or any of your colleagues have any queries arising out of any of the topics that we are covering today. Equally, we'd be really interested to hear from you with ideas of any further topics that you think we might be able to offer. Or if you feel that there is sufficient interest within your organisation for us to perhaps run this session or something similar on a bespoke basis, which we'd be delighted to do. So, just to set the scene, in the wake of escalating COVID-19 infection throughout the UK, the government put in place several measures intended to manage its spread. These measures, which I guess ultimately have you listening into this session today from home and have me climbing the walls and rocking quietly in the corner of my home office, have had an enormous impact on the UK economy. And whilst the government has stepped in to try and avoid an immediate recession and countrywide financial ruin by offering packages of financial assistance, it would not be overstating the situation to say that the UK commercial market is currently pretty much decimated. There have been many high-profile casualties already in the business world, and there can't be many companies and businesses across the country that aren't struggling in some form or another. In what is rapidly becoming a new normal, all businesses are going to be looking at ways both to save money and to recoup their losses. And in that environment, inevitably, litigation is going to rise. Bills will go unpaid, they will be chased more vociferously than perhaps might be the case in good times. And as those of us that are accustomed to dealing with professional liability claims in particular, counterclaims will be coming forward in their droves in support of decisions to withhold payment. Whether those counterclaims have any merit or not will remain to be seen, but certainly, as I say, those of us that have dealt with these over the years will know that a lot of them are just spurious and unfounded attempts to avoid payment, but all of them require dealing with, and all of them end up in the courts, it seems. But as well as litigation, insurance claims notifications will be on the rise and are already on the rise, with policyholders reviewing whatever insurance cover they may have in a desperate attempt to find the funds that could ultimately make the difference between them staying afloat and going to the wall, without wishing to mix my metaphors. And whatever their insurance cover is, whenever that doesn't respond, increasingly desperate businesses are likely to look to others to make good. And their insurance brokers inevitably are going to find themselves in the crosshairs of the proverbial scattergun. So where might claims ultimately arise? Or to put it another way, where are declined insurance claims most likely to result in claims against insurance brokers? We could here discuss any number of classes of insurance which are likely to be engaged due to COVID-19, an analysis of each being likely to be a talk in its own right. Event cancellation insurance, employment liability insurance, trade credit risk insurance, and even to some extent professional liability insurance. They're all good candidates. Claims will be made and rejected. But the one class of insurance that seems to be at the forefront of this issue, certainly if all of the column inches of the various trade presses are to be believed, is business interruption. And in the spirit of keeping to our time today and trying to cover the most ground within it, we're going to focus on business interruption today. So if the various press releases from the market's main business interruption or BI insurers are to be believed, it seems unlikely that the vast majority of BI policies are going to respond to COVID-related losses. Most BI insurers will point to the sheer scale of those losses in support of their argument that a pandemic of this sort simply wasn't factored into their pricing models at the time of underwriting. They will say that underwriting is typically undertaken on a case-by-case or subjective basis rather than on a national or global level. And as a result, if they are compelled to pay out in the manner that the press would have us all believe, much of the insurance market will simply collapse. In terms of legal justification for the market's stance on this, there are all manner of insured perils and exclusions within the myriad of BI policies that are available in the market circulating. And a comparative examination of what was available throughout the BI market at any point in time may well become necessary when evaluating whether the brokers scoured the market well enough at the time of inception of each client's own business interruption arrangements. Each of those exclusions and insured perils may apply or exist in the current situation to limit or deny a recovery of COVID losses. The BI market did a lot of work after the Sars outbreak in 2003 to tighten up its offering, so it's no wonder that so much of the policy wording will now be under scrutiny. As a general rule, because BI is typically linked to buildings insurance cover, it tends to require the existence of an insured peril to be linked in some way to the business premises, with that insured peril causing those premises to be unusable. In most cases, policies require there to be physical damage to the premises in order for cover to be triggered. Can the presence of COVID-19 on the premises really be classed as physical damage to those premises? Most UK commentators and certainly historic UK case law think not, but there has been some confusing case law on this over recent weeks, most notably in Canada, in the case of MDS Inc. against Factory Mutual, the decision of which was released on the 1st of April, where the court in that case said that the presence of COVID on the premises was deemed to be physical damage, in line with previous Canadian and US authorities that dealt with fumes and vapours. But one has to question whether, given the date of the decision, it was something of a policy decision, and I'm sure that that decision is going to be the subject of an appeal over the coming months. But even if a policyholder is able to persuade an insurer, or rather a court, that COVID-19 contamination could class as physical damage, the policyholder will then have more than likely to establish that the infection was present at their premises, or if the policy wording requires it, in the vicinity of those premises. And that's not going to be an easy task. And then finally, even having surmounted all of these hurdles, the policyholder will then, again subject to the precise policy wording, need to link its losses directly to the closure of its premises. And in circumstances where the policy was written assuming that the rest of the commercial world remained open whilst the insured business suffered its interruption, it's going to be difficult for policyholders to overcome their insurer's argument that the losses were actually caused, in this case, not by the closure of the particular premises, but actually by the global shutdown itself, particularly in circumstances where the presence of the infection at or near the premises could presumably have been cleared up very quickly if it weren't for the centrally imposed and long-term shutdown. So by this point, we've probably got a large number of very disappointed BI policyholders. However, having established that physical damage isn't likely to get them home in relation to their claims, policyholders are likely to look at any non-damage extensions that their BI policy might contain. And many, perhaps even most BI policies include such extensions, which typically fall, in our experience, into two categories. The first being infectious disease extensions, and the second being denial of access extensions. Regarding the first of these, infectious disease extensions permit recovery where there has been evidence of the disease either at or near the subject property. But whilst at first glance such extensions appear helpful to policyholders in the COVID context, they're certainly not a slam dunk for a BI policyholder. For a start, evidence will generally be needed that the virus was actually present at or near the premises, which, as I've just mentioned, is likely to be very difficult to prove. And then, as I also mentioned a second ago, there are going to be problems with the extent of the problem and whether it could have been cleared up very quickly. And as a result, the extent of any recovery may be pretty low, if it's there at all. Equally, most infectious disease extensions are drafted using lists of included and sometimes excluded diseases. And obviously, COVID-19 won't have been on any lists at the time that the majority of BI policies incepted, because it simply didn't exist as a named disease at that point. That said, some wordings are couched not in terms of a list of diseases, but in terms of covering any disease that is notifiable to the authorities. And COVID became a notifiable disease in England on the 5th of March 2020, and shortly before that in the rest of the UK. So whilst losses before the date of notification are going to fall outside the scope of any cover in the wordings that use this language, policyholders that have the benefit of this sort of extension may well actually end up being in the best position to get across the line with their claims for losses from the 5th of March onwards. The situation is obviously going to be complicated if a policyholder trades outside of England, as the disease will have become notifiable on different dates in different jurisdictions, and in fact may not even have been notified in some. So it's not going to be an easy claim to pursue, but it certainly, I think, is a better one than pure physical damage claims. As regards denial of access, this is intended to cover situations where, whilst the premises themselves may not be damaged, something has happened at the premises or nearby that interrupts the business. It could be a burst water main nearby, or a bomb scare, or could it perhaps be COVID-19? Policyholders with such language in their wordings may well seek to argue that this is exactly what it's intended to cover, and they may well succeed. But they will need to persuade their insurers that a central government order closing all premises across the country falls within the coverage criteria, particularly anything nearby. And you can imagine an awful lot of argument coming out in that context. Out of interest, this and the first infectious disease extension is pretty much where the arguments are focused in the Hiscox BI wording and the Hiscox action group at the moment that is focusing an awful lot of press attention. And ultimately, BI claims relying solely on physical damage arguments are likely to be declined, with those policyholders carrying helpfully imprecise non-damage extensions being in the best possible position to make some kind of a recovery. For the insurance broker, the issue in amongst the carnage that this issue is inevitably going to create is going to be whether they reviewed the market well enough to maximise their clients' cover, and whether the lack of cover for COVID could have been prevented. Stephen's now going to get out his crystal ball, look into the future and predict what sort of allegations brokers are likely to face.
Thank you, Jay. It's difficult to predict the full extent of the allegations we are likely to see against insurance brokers. These will include, no doubt, a variety of specific allegations driven by a very specific and bespoke set of factual circumstances. For example, based on specific instructions issued by the claimant insured, or specific conversations the claimant insured had with its broker prior to placement. However, I think we can expect a number of common allegations to be made against brokers going forward, particularly brokers of SME type companies. And it's those allegations we'll try to look at now. Before we get into the specific allegations, it's important to note, as Joe said, that the standard BI cover requires physical damage to the property insured under the policy. Without such covered physical property damage or loss being incurred, there is usually no standard business interruption policy response. Unless English law materially changes, therefore, the question of what is physical loss, we do not expect to see meaningful allegations or loss claimed against brokers relating to the standard business interruption coverage, which requires physical loss. Rather, we expect that most likely allegations against brokers are going to focus on the alleged failure of the broker to advise properly as to the availability and the extent of the non-damage type business interruption extensions that Joe has outlined. That is, business interruption extensions that would have broadened out the standard cover, potentially to include pandemic and COVID-19 type losses. As Joe outlined, these extensions include non-damage prevention of access and notifiable or infectious disease extensions. A second point worthy of note is that there may be different time periods that might become relevant in due course. First, there are allegations that will arise from policy inceptions that took place before COVID-19 was ever known about. We can debate the exact dates of when that will be, but let's say that's for policy inceptions that took place prior to January 2020. The second relevant period relates to allegations that might arise from policy inceptions that took place after COVID-19 became a known and developing problem. During that period, certain BI extension covers might still have been available in the insurance market that might have responded to COVID-19. Again, we can debate the exact dates of this second period, but let's say that it's January to the end of February 2020. Certainly by March 2020, I expect that most UK insurers would have already checked that their BI extension wordings did not provide COVID-19 cover, and or would by then have introduced COVID-19 specific exclusions. So there may have been a short window, January to February 2020, when brokers and their insureds might arguably have seen the COVID problem coming and might have been able to take advantage of seeking out specific insurers off the peg policies with broader BI extensions that might have covered COVID-19. With those thoughts in mind, let's now turn to the likely allegations we can expect to see that either will be made alone or potentially alongside each other. I'm going to outline these allegations briefly first and then return to them to deal with them in more detail. First, in the context of general policy inceptions or renewals which took place before COVID was ever heard of, I think we can expect to see allegations such as, "You failed to advise me about the risks I faced from a pandemic and the need to insure against it." It seems unlikely that many, if any, business interruption brokers, particularly brokers with SME insureds, will have advised their insureds and singled out for specific consideration the risk of a pandemic. We'll come back to see whether there might have been a specific duty to advise about a specific pandemic risk in a moment. A second allegation that might be run in tandem with the first, which we can expect to see, is, "You failed to advise me at all about the meaning of the business interruption cover and or the business interruption extensions in my policy. I thought I had very broad business interruption cover that would include any type of government-ordered shutdown affecting my business, including what has happened now with COVID-19. Undoubtedly, there are many SME insureds in this position who probably didn't read their policy wording and just assumed they might be covered for this type of event. Now, some brokers will not have advised their insureds at all prior to placement about the types of events or occurrences covered by the business interruption policy wording and or the business interruption extensions contained therein. And the allegation will be developed to the effect that if you had advised me of such matters, I would have requested an extension or an alternative policy that would have covered my COVID-19 losses. The next likely allegation, perhaps used to get around the fact that some advice might have been given by the broker prior to placement about pandemic risk or the restrictions in scope of cover generally available under business interruption coverage, is you fail to advise me that insurer X's business interruption extension or cover was broader in scope than the extension or cover in my policy. Properly advised, I would have gone with that insurer's policy, which would have covered my COVID-19 losses. Now, as to this allegation, there is no doubt that while the generic description of business interruption extensions contained within policy wordings and generally available in the market at the time was similar. For example, many policies contained automatically business interruption extensions headed up and described as non-damage denial of access, or notifiable disease, or infectious disease, or loss of attraction. Nevertheless, despite these extensions being headed up and in the same way, the reality is that there was a wide variety of breadth of the coverage found across the insurance market within these similarly described extensions. And some extensions with some insurers provided far broader coverage depending on their specific drafting and the specific policy language used. Undoubtedly, the drafting and language used in some of these standard business interruption extensions will provide cover for the COVID-19 events we currently have, whether that was actually intended by the insurer or not. Pausing here for a moment, one would assume, as Joe has suggested, that no business interruption insurer would actually intend to provide off the peg, as opposed to bespoke, business interruption cover for pandemic and COVID-19 type events. The reason being that the systemic financial risk of such an event was simply too great to insure, and no insurer's balance sheet could take the hit of a UK-wide pandemic event as we now have. That, I think, is going to be a relevant issue for the courts to consider when looking at related broker negligence claims, and what the broker actually did and arguably should have done in various scenarios. The theme we'll return to shortly. It's also worth noting here that the ABI has estimated that there will be circa £900 million UK industry payouts on business interruption policies. The suggestion is that this is effectively for non-contested business interruption coverage, which clearly applies to the COVID-19 situation. Of course, as Joe mentioned, there are numerous developing contested cases, including Hiscox and other insurers, which could ultimately result in a far more extensive industry payout. So one of the difficulties in defending this specific allegation will be that there do appear to have been business interruption extensions available in the market that would have covered a pandemic event like COVID-19. Although there may be a debate about whether that cover was intended or not. Each of the allegations identified so far, of course, will face potentially difficult scope of duty, evidentiary and causation hurdles, which we will also come on to in a moment. A further allegation that might well be made, therefore, in an effort to circumvent some of these difficulties faced by claimant insureds, is a more bespoke type allegation that, properly advised about standard business interruption cover and the extensions available, I would have instructed you, my broker, to obtain bespoke pandemic cover, which would have covered me for my COVID-19 losses. Now, one can expect this to be a difficult argument to run for an SME insured, although perhaps easier for a larger insured with bespoke insurance requirements and with a risk and commensurate premium which would justify such bespoke attention. And finally, in terms of the allegations we might expect to see, some policies will have been placed during the period January to February 2020, and the claimant insured may therefore try to introduce additional nuances to the allegations already mentioned to the effect that as the COVID-19 problem became known through January and February 2020, and it increasingly looked like a worldwide problem that would move beyond China's borders, then a more specific duty or a heightened duty arose on the broker to advise on the availability of cover for the specific COVID-19 problem. We're going to come back to some of those allegations in a moment and look at them in more detail, but I first wanted to make some general comments relevant to the broker's work and the duty of care the broker will owe. Whether the broker is sued in contract or tort, like any professional, the broker is required to exercise reasonable skill and care. In other words, he or she is expected to demonstrate the degree of skill and care which would be exercised by the reasonably competent insurance broker. This required level of competence and skill and care could in theory be increased or decreased by any express terms of the contract or the terms of business in place between the broker and the client. But for today's webinar, we're going to assume that most terms of business will simply repeat rather than seek to alter this implied reasonable skill and care obligation. In addition, as we all know, brokers are obliged to comply with the FCA's ICOB source book, and the courts have held that a failure to comply with such ICOB's rules will usually also equate to a failure to act with reasonable skill and care. Just as a quick reminder, Rule 5.22 provides that prior to the conclusion of the policy, the broker must specify, on the basis of information obtained from the customer, the demands and needs of that customer, and a statement of the demands and needs must be communicated to the customer prior to the agreement of the policy. Further, Rule 5.3.1 requires that the broker must take reasonable care to ensure the suitability of its advice to its client, who is entitled to rely upon the broker's judgment. Taking this together, it means that the broker has an obligation to make inquiries of its client as to its client's insurance needs, and to question the client so as to elicit relevant information as regards the client's business interruption needs, which may not otherwise be volunteered. All of that is required to ensure that the broker can then ensure the suitability of its insurance recommendations. Now, in determining in any specific case whether the defendant broker has complied with its duty to exercise reasonable skill and care or not, expert broker evidence as to the practice of insurance brokers will be expected to be presented and will carry great weight with the court. That's not to say that the court will entirely abdicate its decision-making to the expert brokers, and in exceptional cases, the court may consider that the ordinary practice of insurance brokers, as described by the expert brokers, is in fact unduly lax, and that the reasonably competent broker should do more. So, while there are various obligations on the broker, for example, to advise its client as to the duty of fair presentation, for our purposes today, in focusing on business interruption type allegations, the relevant case law confirms and can be summarized as follows. The nature and scope of the broker's obligation to assess its client's business interruption needs will depend upon the particular circumstances of the case, including the client's sophistication, which is an important issue, and the relevant advice the broker has given the client in the past, which the broker can expect the client to recall. And importantly, per the Eurokeys Recycling Authority, the court has said very clearly in the context of business interruption that a broker cannot assume that an SME will have any understanding of the nature of how business interruption insurance works unless the broker itself has explained that clearly to the insured. And so a broker will need to advise broadly on business interruption, how it works, and to include within that advice on what is covered, what is not covered, and to check carefully that the client has understood that advice and whether the client has any specific business interruption needs. In summary, the broker's key obligations on placing business interruption are going to be to take reasonable steps to identify the type and scope of cover which the client needs, to take reasonable steps to then arrange that insurance cover which the client has instructed him or her to obtain and which has to be suitable for that client. And then if they're unable to arrange that cover, to obviously tell the client. And further, once the cover has been placed, to carefully explain to the client what cover has been arranged, and then upon any renewal, to go through the same exercise again. Subject to any specific instructions that might be received from the client, therefore, it is the duty of the broker to identify and advise the client about the type and scope of cover which the client needs, and in doing so, to match as accurately as possible the risk exposures which have been identified with the coverage available. While the issue of the breach of duty will depend in part on the sophistication and knowledge of the client insured, the court cases confirm that the broker has an obligation to make inquiries of its client as to its insurance needs and to question the client so as to elicit relevant information to allow the broker to obtain the correct insurance cover. There are, however, some limits to the scope of the broker's duty to make inquiry of the client. A broker will not be found to have acted negligently if it fails to raise questions about the risk to be covered, which it had no good reason to ask. Or if a broker receives clear instructions from his client to place a certain type of coverage or element of coverage and to ignore another potential coverage or element of coverage, then the broker is not going to be under an obligation to obtain more extensive cover than he has been instructed to obtain. Now, with those overarching thoughts in mind about determining whether a broker has done a competent job or not, I'm going to go back and have a quick look at some of the specific allegations that we have identified. The first allegation was that you failed to advise me about the risks I face from a pandemic and for the need to insure against it. Leaving aside unusual cases with unusual facts, most clients will have either instructed their broker simply to help them with their general insurance requirements in the context of their specific business, or will have instructed the broker to place specific coverages, for example, EL, PL, or business interruption. For example, taking some of those areas hit hardest by the current lockdown, in the context of businesses such as hotels, pubs, and restaurants, the broker will likely have received a high-level instruction to advise the client on and to place or renew policies across a whole range of obvious exposures, including EL, PL, employment practice liability, property damage, theft, legal expenses, etc. Most of these clients may already have some type of business interruption cover in place already, either as advised by their former broker or the current broker. Although some clients will have been advised for the first time to consider taking out business interruption cover. Quite likely, in the context of the broker placing several classes of insurance for its client, in the hotel, pub, or restaurant example, there will have been little specific initial thought by the client or indeed the broker about these specific business interruption cover beyond the fact that the client needs such cover in case it is impacted by some future event. If any thought or discussion has taken place with the client as to what type of events might be protected against, then it's quite likely that such discussion has not gone beyond the obvious events like flood and fire, and that the client has simply instructed the broker to test the market and report back with coverage options and prices from various insurers. Assuming this type of general client instruction, the question then arises whether the broker had an obligation to advise about the specific risks of a pandemic to the insured and the potential need to cover that as a business interruption risk. In reviewing this issue, first, I do not think that the broker can argue that a pandemic was unforeseeable. One reason for this, as Joe has said, is that we had the Sars issues in 2003, 2004, which, very much like COVID-19, SARS was a new respiratory infection disease not previously known to man. SARS was in effect a type of dry run for the insurance market for today's COVID-19. It was arguably only the difficulty of transmission of SARS between humans that meant SARS quickly fizzled out and restricted in economic effects, largely to Hong Kong and China. Contrast that with COVID-19, which, because it is so infectious, has had a massive worldwide impact. It's important to note, as Joe mentioned, that after SARS, insurers generally took on board the pandemic risk and most tightened up their business interruption policy wordings materially to limit pandemic type cover. To restrict, for example, cover to named diseases or specific locations, deliberately restricting the cover for the risk of general infectious outbreak, such as we now have with COVID-19. It must be right, therefore, that brokers should have likely been aware of the risk of SARS-type outbreaks. And so COVID-19 cannot be described as unforeseeable and something that no broker could have contemplated. Claimant insureds will likely therefore argue that as the risk of pandemic was foreseeable, it should have been part of the broker's suitability questions, and it should have been expressly raised with the client as a risk, and specific instructions should have been sought thereon by the broker as to the insured's appetite for cover. Such issues, however, will need to be put in the context of a typical combined lines renewal. And one counter-argument on the defence from the broker will be that if such specific instructions had to be taken on whether pandemic type cover was required, given pandemic events are of a low probability compared to, example, fire or flood, then what we're saying is that instructions would have to be taken on so many other numerous and similarly unlikely or obscure issues that the whole renewal process would become protracted and unviable. Likely that argument will carry some weight, but ultimately the issue will be one of expert broker evidence and the court's review of that expert evidence as to what a reasonably careful and competent broker would do. As always, views of the experts will differ, and claimants will no doubt find some expert broker to support their view. My personal view is that I expect realistic expert evidence on this point will likely favour the defendant broker, in the sense that it will show that the broker market as a whole was not giving this type of specific pandemic advice, at least not giving that advice to smaller SME type insureds, not least where renewals of numerous lines of business were being dealt with at the same time and often within one policy, and there were far more pertinent and direct issues to consider and advise the client on. If the expert evidence was that few, if any, brokers were advising insureds of the need to consider specific pandemic issues, then the question becomes, would a court ignore such expert evidence and hold that nevertheless a broker had an obligation to specifically raise the pandemic issue for discussion with its client and to seek instructions thereon? One would hope that this is unlikely, albeit it is clearly possible. That said, even if a court did so find, there will be material causation defences to run, which Joe will come on to in a moment. The second allegation we put forward was that you failed to advise me at all about the breadth of the business interruption or business interruption extensions in my policy. I thought I had very broad cover that would cover any type of government shutdown, including these COVID-19 events. Now, some brokers, for example, with SME clients, will not have carefully explained to the client, as they arguably should have done, the meaning of the various business interruption extensions available, and will not have given clear examples, as they probably should have done, to the client of what would and would not be covered by such business interruption extensions. Nor will some brokers have advised the client to think about what its specific business interruption needs were. Perhaps just as important, many brokers may have given verbal advice about such matters, for example, in a renewal meeting, but will not have recorded that advice in writing, and the client may now have a different recollection of events. In either case, I would suggest that the broker is at real risk of being found to have acted in breach of duty. As already discussed, the non-negligent broker has to identify the type and scope of cover which the client needs, and this must almost certainly include some reference to the extent of business interruption cover required and the type of risks business interruption covers, and an explanation to the client as to what business interruption does not cover, and therefore which risks the client must bear itself uninsured. Turning back to the third allegation, which was that you failed to advise me that another insurer had a policy with broader coverage that would have covered me, and properly advised I would have gone with that insurer. A broker is, of course, obliged to test the market for the benefit of its insured client, to compare the cost of required insurance from various alternative insurers, and at some minimum level at least, to compare the scope of cover available from those different insurers. The broker will therefore need to consider the correct mix of price, policy terms, and the adequacy of any insurer's security as part of advising its client of the available insurance options and what might be suitable for that client. Policy wordings, as we know, will vary between insurers and lines of business. So it is crucial that the broker understands and explains to its client the scope of business interruption cover available in the marketplace. Again, subject to any specific contractual promises made by the broker about, for example, price comparison, scope of coverage, or adequacy of security, the broker will need to have acted as a reasonably competent broker would in assessing all of these issues and in advising the insured of its insurance options. Broker's work is unlikely to require a price or terms comparison of every business interruption insurer in the market, or to necessarily require a full price or full comparison of business interruption terms and scope of coverage review to be undertaken on every annual renewal. However, there will be some minimum requirement, depending on the context of the broker's instruction, to compare competing business interruption insurers' policies and their scope of coverage, so that the broker can competently advise the client of its insurance options. Again, much is going to turn in these future claims on the relevant expert broker evidence about what a competent broker would have done in the particular circumstances of any particular case. quite likely, sitting here today, we do not know enough yet of the extent of the business interruption extension coverages that were available in the market at material times and which would have covered COVID-19 to provide a more definitive view on the strength of this particular allegation. The more insurers who were providing business interruption extension cover that would cover pandemic and COVID-19 type events, the more problematic this particular allegation will become for the broker, as the claimant insured is able to point to more and more insurers who would have covered his losses. Presently, it seems a small number of insurers' business interruption policy extensions would have provided cover for the current COVID-19 issues. So the outcome of this particular allegation will in material part depend on, first, the number of such policies that were available in the marketplace which would have covered COVID-19. And second, a particular point as to the extent to which those policies intended to give pandemic or COVID-19 type cover, as opposed to policies which unintentionally gave such cover. There is no doubt that a number of policies out there will provide COVID-19 cover. However, they will not have been intended to provide COVID-19 cover. And perhaps Hiscox's policy falls within that category. They will unintentionally have given the cover because of the lax drafting in the policy wording. In terms of how the court will approach this particular allegation, the court authorities do support the view that a broker will not have an obligation to specifically check all market policies for unintended and lax insurance policy drafting in some type of effort to find where broader unintended business interruption coverage might be obtained for their insureds. However, if many mainstream insurers with adequate security and price were providing obviously broader business interruption cover than that available elsewhere, there was going to be a reasonable argument to make that a competent broker in advising on business interruption policies should have known about the availability of that coverage and should have included it within its recommendations to its client. This is where our earlier comments about the reason why any business interruption coverage in the market will respond to the current COVID-19 claims becomes important. Was that coverage intended or was it unintended? Ultimately, we're going to have to review all these issues as further information emerges about what part of the market and how extensive that part of the market was that will or would have covered these COVID-19 issues. Moving back to allegation 4, properly advised about business interruption coverage, I would have instructed you to obtain bespoke pandemic cover. As mentioned, this will be a difficult argument for SMEs to run, given the evidential hurdles they will face. Such claims will likely need to be run on a loss of chance basis. First, the insured claimant will have to persuade the court that on the balance of probabilities, it would have instructed the broker to obtain specific pandemic coverage. That seems unlikely in the case of most SMEs, not least for price reasons. And second, the insured claimant will have to persuade the court that on a matter of loss of chance basis, the hypothetical third-party insurer would have responded and provided bespoke pandemic cover at a reasonable price. These hurdles look steep for anything other than insureds with significant bespoke risks and with significant premiums in play, which would justify such bespoke type approaches to cover. The final allegation we raised is in the context of the arguable period January-February 2020, where the claimant insured may argue that whatever the duty the broker ordinarily owed, this was extended or heightened due to the broker's knowledge and general public increasing knowledge about the developing COVID-19 problem. A quick review of the relevant chronology shows that China announced effectively its discovery of COVID on the 31st of December 2019. Around the 13th of January, the first case of coronavirus outside of China was confirmed. Even by the 22nd of January, Public Health England was only moving its risk level to the British public from very low to low. And it seems that on about the 29th of January was when the UK first confirmed 2 patients within this jurisdiction had tested positive for COVID-19. By 30th January, the World Health Organization had declared COVID-19 a public health emergency of international concern. And of course, by the 5th of March, the government in the UK added COVID-19 as a notifiable disease. The chronology suggests, therefore, that there might be a narrow window, probably no longer than the month of February, where these additional arguments, if run by a claimant, might have some traction. Again, it is all going to depend on the specific circumstances of the insured and what cover was available in the market at any particular time during this small window, and of course at what price such cover was available. Equally, given that a competent broker will be looking at a renewal weeks ahead of time, the broker will also be able to argue that its renewal process and obtaining of quotes was already in motion prior to this February period, and it was too late to change track and look for a new policy in the last moments of February. Having looked at some of the specific allegations and the breaches that might be found, Joe's now going to look at some of the key causation issues which are in play.
Thanks, Stephen. So having concluded that at least some prospective claimants are going to get over this duty threshold, and that breach in those circumstances may not be particularly tricky to ascertain, causation is the next issue that disappointed policyholders are going to need to prove if they are to claim successfully against their insurance broker for their COVID-related losses. This is likely to be a key battleground in such claims. Put simply, the question that will need to be asked of the claimant is whether, if the broker had advised them of the existence of the cover that they say ought to have been in place, then the policyholder would genuinely have acquired that cover. Now, many issues are likely to arise at this point from a causation perspective, but 2 in particular spring instantly to the forefront, being firstly the cost of the cover that the claimant says they ought to have had in place, and then secondly, the availability of that cover in the market. Now, as regards cost, express pandemic cover, as Stephen alluded to, would, I suspect, have been prohibitively expensive for all but the largest of policyholders with the most comprehensive of insurance programs. And the cost of just better BI cover, is also likely to have been higher than the cost of standard cover, meriting some kind of an explanation as to why that difference in cost was justified. The question is, would a claimant be able to persuade a court that they would have paid this extra if they had been advised? Obviously, it will depend on each case as to whether they are able to do so. As regards the availability of cover, there will have been only limited markets available in the bespoke sector, and they will have been able to be very choosy about who they traded with. Did the broker in this case have any trading relationship with those niche markets? And if so, would this particular claimant even have received terms from them, or would they have just been rejected out flat? The deeper that we have to delve into this issue, the less likely it will be that a court will view it as being within the scope of a general broker's duty to go that far. There's going to be a huge amount of 2020 hindsight applied by claimants to this analysis, and the courts are going to be very wary of it. The claimant will need to demonstrate a history of risk aversion if they are going to succeed. Did they have a full program of other covers to demonstrate that they were fully protected and that that was a key thing for them? Or conversely, is there evidence on the broker's file that previous advice from the broker to broaden out their program has been ignored or overlooked? Things like cyber cover or income protection cover, I would say, and certainly I think a broker would argue, would be a much more pertinent level of cover and something that is much more likely to be called upon than pandemic cover, when the last pandemic to be seen on UK mainland was back in 1918. And I would suggest this argument is likely to have quite a lot of court sympathy, especially if the claimant is struggling to demonstrate this risk-averse tendency that they will need to get over to surmount this 2020 hindsight issue. So ultimately, I think it's going to be very difficult for policyholder claimants to prove that they would have bought the extra cover if so advised. Now, obviously, there are going to be exceptions to this. The comparative claim that Stephen has talked about earlier might be one such exception. Such a claim may have a lower causation threshold than the pandemic claim. In other words, we're not talking here about the "you should have got me full pandemic cover," but rather you should have given me a full breakdown of the BI market so that I could then have made an informed choice as to which BI cover was best suited to me, and I would have chosen insurer X, and that would have given me a COVID recovery. But whilst a claim framed in this way may seem plausible, such a claim will still face difficulties. As Stephen has said, any BI policy that pays out in respect of COVID is likely to have been forced to do so in circumstances where that cover was never intended at the time of underwriting. So against that backdrop, it's hard to see how any competent broker undertaking that comparative exercise of the BI market would have described any insurer's standard BI offering as including pandemic cover, unless relying on a potential technical legal interpretation of the wording. And I would say that any court is going to have to work very, very hard indeed to impose a liability on a broker for failing to undertake a technical legal interpretation of the wording in those circumstances. A second possible exception to the general idea that claimants will struggle to prove causation is if their BI cover was up for renewal in that period that Stephen was mentioning, leading up to March 2020. For this very small potential class of claimants, they may be able to argue with some force that at this time awareness of COVID was rising and its potential was starting to be realised, and that as such their broker ought to have had it in mind and ought to have advised accordingly. The claimant's arguments that they would have bought pandemic or enhanced BI cover if offered may well get a bit more court time in these circumstances. However, even here there are challenges. BI insurers were also alive to the rapidly developing situation, and they were themselves reacting to it by adapting their wordings. So whether there were any bargains to be had in that short window, which we've described as being possibly limited to February 2020, well, that will need to be proved by the claimant on a case-by-case basis. Nevertheless, this short period seems to me to be a possible danger zone for brokers. Before then, and all of the arguments that we've discussed at length up until this point in the webinar will apply. And obviously since March, all policy wordings have been tightened up, so there has been no real opportunity to obtain more favourable terms for clients in any event. And Stephen's going to speak shortly about what the future might look like in terms of revised policy wordings across all classes and what future dangers the new restrictions on cover may present for brokers. But for now, I'll deal very briefly with the issue of what policyholders might conceivably recover from their brokers if they manage to surmount all of these various hurdles that we've discussed thus far. So the usual rule on recoverability of damages in broker cases is that the insured's claim, or the policyholder's claim, is limited to the insurance monies that he would have received but for the broker's negligence or contractual breach. And that's going to assist brokers where the underlying coverage would have been sublimited. And certainly as regards a lot of the BI cover that we're seeing, we have seen quite a lot of sublimits, and a lot of them are around the 50 to 100,000 pound level. So that potentially is very good news from the point of view of limiting what a claim might look like. However, unfortunately, where the loss relates to business interruption insurance and the policyholder has got insufficient funds to get back up and running without the insurance monies and ends up going under or suffering further losses, the broker may also be liable for consequential losses following the authority of Arbery and West Craven in 2007. Now, in that case, a fire damaged the policyholder's premises. The policyholder was underinsured due to the broker's negligence. The amount that the policyholder received from the insurer in respect of its losses was insufficient to get it back up and running. And as a result, the policyholder suffered ongoing losses that were really affecting its trading performance. And the court in that case held that the business interruption insurance as a concept should be distinguished from other forms of insurance and distinguished from what might be considered to be the usual situation in broker's negligence, whereby the amount of the loss is limited by the amount of the underlying policy. Because the court said it was designed as a concept, BI was designed to inject additional funds into a going concern in order to maintain it as a going concern. And therefore it's entirely foreseeable that there should be a full recovery from the broker in that situation. Now, the court held that the broker's duty was to ensure that sufficient business interruption cover was in place to enable the company to recover and to resume its pre-fire level of profitability at the earliest date, and that it was reasonably foreseeable that a failure to effect sufficient cover would adversely affect the profitability of the policyholder's business. So on that basis, the judge in that case held that the policyholder should recover full damages for both the shortfall in its insurance claim due to the underinsurance, but also the loss of consequential profits suffered by the policyholder as a result of that shortfall. So not such good news for brokers. And in certain cases, this will lead to an unfortunate dilemma for the broker. There will be situations where the policyholder comes to the broker seeking damages for the insurance monies that it says should have been received, and alleges that if those monies aren't paid immediately, then the company may well fall over. And as a result, the losses will increase. So the broker in that situation will be faced with the dilemma of the choice of settling early with the client on the one hand, and thereby keeping it in business, or not doing that and facing an increased damages claim further down the line. Now, obviously, in such a scenario, speed is going to be of the essence in analysing the validity of the policyholder's claim against the broker and deciding on an appropriate defence strategy. The business interruption policy indemnity calculation terms will also be key in calculating the correct quantum of the claimant's claim, and these will determine what the insured might have recovered under a properly placed BI policy. So, for example, see the Orient Express Hotels case, and in that case, a hotel closed in New Orleans due to damage caused by Hurricane Katrina, and the insurers did pay some of the covered sublimit for loss of attraction and prevention of access, where extension didn't require damage to the hotel itself. But there was a dispute about the main insuring clause in the BI policy, which had a materially larger limit of indemnity, but only covered business interruption that losses that were caused directly from the damage to the hotel. And in that case, there was a trends clause in the policy that provided that when calculating the insured's loss, adjustments should be made to allow for trends which would have affected the hotel's trading performance had the damage not occurred. And given that the whole of New Orleans was effectively underwater and nobody was visiting the city in any event, in this case, it meant that the hotel would not have earned any profits, even if it had remained open. And so as a consequence, no loss ended up being payable under that section of the BI policy. And one can see this style of argument being deployed extensively by BI insurers in the COVID environment, subject obviously to the policy wording permitting it. Mitigation is another issue that is likely to be relevant when dealing with claims against brokers in this context. Usual mitigation loss rules are likely to apply, both arising from common law and the specific terms of BI policy wording that did or should have applied if the broker had not been negligent. As an example of this, the burger restaurant business McDonald's has shut all of its restaurants rather than continue to act as a takeaway only. And takeaway businesses are, as you may know, still allowed to operate through the lockdown if they wish to. So there may be some difficulties in claiming all losses in that scenario when the decision to cease trading was effectively voluntary. And this would need to be factored into the claim against the broker. If it couldn't be claimed against the BI insurer, then it surely can't be claimed against the broker. Finally, there's the issue of contributory negligence. It's something to consider, but it may not really feature highly in these types of claims. It's very fact specific, and given the nature of the professional relationship between insurer and insured, between broker and insured, it is a professional one where the client will rely on the broker to advise it as to its needs. It's hard to see there being a huge amount of contributory negligence applying, but nevertheless, it's something to consider. As is actually third-party recoveries, where you've got a chain of brokers. The sub-broker, if you're sitting as a placing broker rather, may well have a better relationship with your insured, and as a result may owe a slightly higher duty than the placing side to explain to the policyholder the true extent of the terms that it is binding itself to. And so if the allegations relate to a failure to explain the cover properly, then it may well be it's the sub-broker that's more in the frame than the placing side. Equally, there may be duties breached as between the two brokers, which is worthy of claims in their own right. So ultimately, even when a claim gets this far, and as we've seen throughout this webinar, and apologies that we've gone just slightly over our hour, but even if a claim gets this far, despite everything that we've said, there are still likely to be good arguments available to the broker and its PI insurers to mitigate their ultimate exposure. So I hope that has been of use, and I'll just pass over to Stephen to sum it all up.
Thanks, Joe. Well, we've reviewed a number of expected negligence allegations that we can expect to see against brokers going forward, and the related breach and causation defences that might be deployed. While some insight can be learned from this crystal ball glazing, it is important to stress that every case will largely turn on its own facts, and that given the scale and breadth of the losses being incurred by tens of thousands of insured businesses across the UK, then we do seem to have the unfortunate ingredients for widespread claims against both insurers and insurance brokers in respect of these COVID-19 issues. I want to leave with three final points. First, it seems many claims will be pursued against various BI insurers, where there do appear to be real prospects at the court, and importantly, the financial ombudsman will find that cover in fact applies. We've already seen reference to certain group actions against certain insurers, and I think we can see more, we will see more in the coming weeks. The FCA has now said that it will seek early court rulings on specific business interruption policy wordings in an effort to seek to reduce the uncertainties faced by the businesses across Britain making claims. And for this purpose, the FCA has said that it requires all insurers to inform it by the 15th of May what its position is on its business interruption policies and what specific wordings it is or isn't paying out on. We can expect to see an expedited court case thereafter dealing with some of these key wordings that will be important to many thousands of insureds. Ordinarily, more business interruption claims being covered should mean that there are less claims made against insurance brokers. Paradoxically, however, we may find ourselves in a situation that the more mainstream business interruption insurer policies are held by the courts to cover COVID-19 losses, then the more we will see other insureds who are placed with policies which clearly do not cover COVID-19 losses, the more we will see them arguing to allege that their brokers should have placed them with those other insurers where they would have got cover. The second point we've looked at today is the court's approach to the potential negligence claims against the brokers, but we do need to bear in mind that the FOS will have jurisdiction to deal with many of these claims, particularly SME claims. Since April 19, the FOS now have a jurisdiction of up to £350,000 to hear small business claims, and small businesses qualify if their turnover is less than £6.5 million and either they have less than 50 employees or a balance sheet under 5 million. That, of course, is going to include a lot of SME type insureds across Britain. We can therefore expect to potentially see many claims against insurers and insurance brokers pursued in front of the FOS at little expense to the claimant insureds. And of course, if the claimant insured doesn't like the FOS's final decision, it's still then free to litigate through the courts should it so choose. And finally, as Joe mentioned, looking forward as to the risk of a further potential source for other COVID-related claims against insurance brokers. It now seems that a significant number of policies across all lines of business are being renewed with general and blanket COVID exclusions. Looking ahead and going forward, brokers will need to be very careful when advising their clients on the potential impact of such exclusions. For example, take the case of a professional indemnity policy with such exclusionary language included, where all members of staff may now be working at home because of COVID-19 and lockdown issues. Depending on the exclusionary language used, which might include broad and wide-catching language like directly or indirectly arising out of COVID-19, it may be that claims arising from work, for example, undertaken at home by workers working off laptops with insufficient resources, could potentially be excluded. Brokers will need to be very careful to highlight these future risks to their insureds to avoid any rebound on the broker's own position. With those final comments, that brings our webinar today to a close. I'd like to thank everyone very much for joining us. As Joe said at the outset, we will be sending a recording and slides round to you. Please feel free to distribute them to your colleagues, and please do feel free to contact Joe or I to discuss any issues arising out of today's webinar. With that, my final thanks to everyone for attending. Keep safe and keep sane.